oil goes for a walk. Oil prices rose slightly on Wednesday, gaining for a second session thanks to positive investor sentiment over the potential U.S. China trade talks to be held this weekend, and also signs of a lower U.S. shale output, which means lesser supply and therefore hopefully higher prices. Brent crude futures are now around $62.70 or just under $63 a barrel. Reuters reported that the U.S. and China are due to meet in Switzerland this weekend, and this could be a first step towards resolving the trade war that's disrupting the global economy. Brent crude earlier hit a 4-year low after the Organization of Petroleum Exporting Countries Plus decided to speed up its output increases. And on the other hand, US producers, or some of them, have said that they would cut spending, cautioning that the country's oil output may have peaked, which is also contributing to the uptick in the market, analysts told Bloomberg. I reached out to Bjarne Schieldrop, Chief Commodities Analyst at the Oslo headquartered SEB, and I began by asking him how he was computing the various demand and supply stress points in the oil market right now.
To start with, it was quite confusing and surprising, and I think it took the oil market with surprise when they announced that they would lift production first by 411,000 barrels per day in May, and then yet again this week, and a new message of a triple of the planned original increase. I mean, they planned to increase by 137,000 barrels per day per month, all the way to December 2026, sort of a steady good plan. And then suddenly everything changed, and now they are sort of tripling the monthly output and lifting in production much more. The first appearance of the reason for this was, of course, these internal quota breakers. Kazakhstan, Iraq and United Arab Emirates produced more than they should, and they had done so repeatedly, and they were supposed to cut back to amend for previous breaches. And that sounded like plausible explanation to start with, but now latest days increasingly we're starting to question that as the main reason, because I mean we're talking about a few 100,000 barrels of breaches, that being the foundation of OPEC Plus or Saudi Arabia together with Russia just throwing in towel and changing strategy totally. It's kind of a stretch as an explanation. And I think increasingly this boils down to the original plan OPEC Plus with their cuts was, all right, they cut deep and hard during COVID-19. And as a world emerges from COVID-19, world accelerates, and then global demand growth was supposed to grow more than non-OPEC plus supply, so that OPEC nicely could put back what they had cut under COVID, right? And I think that was still sort of the plan when they announced that, okay, from April, they would lift production by 137,000 barrels per day per month, December 2026. Sort of gradually ease it back into the market and everyone being happy and oil price not suffering too much. But I think what really broke that strategy was definitely the trade war from Donald Trump, which is then endangering global growth. It's endangering oil demand growth, of course. And then the whole plan of OPEC is just pushed out to infinity. And I think that is why they say, all right, fine, that original plan didn't work. So we just have to sort of, facing weaker global growth and demand growth, we just have to sort of get on with the job of getting the production back into the market. And then the solution of the whole issue will then be less production from U.S. shale producers and more demand from global consumers in the face of lower oil price.
At this point, the United States is looking like it's going to step up production. OPEC Plus is stepping up production. So there seems to be, as some analysts are saying, a consensus that the US is pushing OPEC to produce more or reduce prices, and the US wants lower prices. Are we able to look ahead and see where this could land? And it could be good news as well for countries like India, because we'll see lower oil prices for a much longer period of time. But how are you reading this?
I mean, if you look at drilling rig count in the US, it has been sort of steady state around 480 oil drilling rigs since July last year. And I think that is where you would supposed to be seeing decline in activity in the US. What we've started to see, I mean, one of the big questions is where exactly is the pain point of US shale producers? Like Bloomberg and Finance says it's like from cost break even from 40 to 60 with an average volume weighted production of around $50. But recent report from Dallas Fed doing a survey of U.S. oil producers, CEOs, basically came back and said that the cost break even at the profit level needs to be $65 per barrel on average. And now the VTI price is below 60, both in the front and 18 months down the road. So we are well below that. Okay, so maybe they have zero cash flow at 50 and still surviving, but they then cannot plow cash flow back into new production. And we had a Diamondback out in the market talking about what they're planning to do. And they say, all right, we're actually going to cut 3 rigs and 1 frac crew and cut CapEx cost by $400 million this year, and basically saying we probably have peak production behind us for this round in early this year. And we're going to go downhill, and rig count is going to fall by 10% in the second quarter. So I think definitely prices are starting to hurt shale producers. They are starting to change their strategy. And basically, to make the equation add up, there is only one sector where you can have declining production rather quickly over a year or two, and that is indeed U.S. shale production. So if OPEC going to take back more market share faster, it basically means that the price needs to be at a place where U.S. production actually is declining.
We've seen all the tariff wars and we've seen shifts because of that. We've also seen America say, for example, that you cannot buy from Venezuela and so on. So how are you seeing flows today? I mean, in terms of where oil is being produced, how it's being shipped, and where it's being consumed. I mean, do you see any shifts in that because of all the trade wars that we've been seeing, or the trade dynamics that we've been seeing in recent months?
Such a confusing picture, isn't it? With Europe or the EU not take crude and oil products from Russia, so they have to send it around the world. And then instead, the EU imports from the US and the Middle East and oil products, maybe from India, re-exported from China. So, I mean, it's really a total change in flows. If you only look at the US, I mean, they only have a net surplus production of around 2 million barrels per day. If you look at what total production of liquids versus total consumption of liquids, including natural gas liquids and so on. But of course, they import huge amount of oil from Canada. At least that was the usual plan before the tariffs. So therefore, net exports are quite strong out of the U.S. Gulf because they import from Canada further north. But also they have quite strong imports of crude from the Middle East because the refineries are made for heavy sour crude or medium sour crude originally, because the U.S. expected to have a deficit of oil. So, it's a huge flow of crude and products around the world. But U.S. is, I mean, Donald Trump was announcing that we're going to have $50 oil and the U.S. is going to increase production with drill, baby, drill. Of course, that is the fantasy. We're going to have lower oil prices and lower U.S. production.
Bjorn, thank you so much for joining me.
Thanks very much for having me on.